Bismillahirrahmanirrahim. In the name of God, the most merciful and beneficent. Week 9 is about financial statement analysis. What is meant by financial statement and what is meant by financial statement analysis? What are the objectives behind preparing the financial statements and who are the users of financial statement analysis? So first of all, financial statements, then objectives of the financial statement analysis, then users of the financial statement analysis, and in the last, a possible framework for analysis. A document that records the financial activities and state of an organization or business. Simple is that any file, any document in the written form that records the financial activities of a business, that is called financial statements according to the Collins Dictionary. According to Investopedia, financial statements are written records that convey the business activities and the financial performance of a company. Means these are the written records which shows the financial position and operating performance of a business at a given time period. Financial statements are often audited by government agencies. It means that the financial statements can be scrutinized by the government agency, by accountants, by firms, etc. in order to ensure accuracy for tax, financing and for investing purposes. So here one thing is very important, that is what is meant by audit. There are two types audit. One is internal audit and the other is external audit. Internal audit, when the internal auditor of the company audit the accounts of the business. External audit means when the external parties scrutinize the accounts of the company. That is called external auditing. Auditing simply means to correct the accounts, to scrutinize the accounts in order to correct the accounts. It simply means to check the financial statements whether it is according to the GAAP rules or not, whether it is according to the principle of accounting, whether the financial statements are recorded according to the principle of accounting or not, according to the GAAP rule of accounting or not. So this is called auditing. What is meant by financial statement analysis? The analysis of the financial statements is the process of reviewing and analyzing a company's financial statements in order to make better economic decisions. These statements include the income statement, balance sheet, statement of cash flows, and a statement of changes in owner's equity. It can also include notes to the financial statement. It can also include changes in the retained earnings statement. So there are 5 to 6 statements which are included in the financial statements, and when we are reviewing and analyzing these statements, this is called the financial statement analysis. Means analyzing the balance sheet, analyzing the company's income statement. So analyzing the company's income statement, balance sheet, these are the basic accounting statements. So income statement, balance sheet, statement of cash flows, and changes in the statement of changes in the owner equity. If you are analyzing these statements and reviewing these statements in order to make better economic decision, Why you are reviewing these statements? In order to make better economic decision. So this is called financial statement analysis. The next is objectives of financial statement analysis. There can be multiple objectives of financial statement analysis. The objectives of financial statement analysis are presented below. Number one, to estimate the earning capacity of a business concern. Any type of business, whether that is manufacturing, whether that is service business, or that is any type of business, you can estimate the earning capacity of that business by following the financial statement analysis or by analyzing the financial statements. To find out the operating performance of a company. Operating performance means how the raw material are converted into finished goods and how finished goods are sold out in the market and how the company collect the cash from the customers, and in the last how they are again purchasing the raw material for the business concern. This is the whole operating cycle, and to efficiently control this operating cycle and to efficiently run this operating cycle, we find out the operating performance of a company. If the operating performance of a company is good, it means that the overall business performance is good. To examine efficiency of various business activities. It means to check each and every activity, whether that is purchasing or whether that is account receivable activity or that is cash collection activity, to check all the activities of the business, whether it is running efficiently or not efficiently. To find out the financial performance of a company. Financial performance means return on assets or return on equity, or the profit, the net profit a business gain after a certain period of time. For example, that can be 1 year, or that can be a quarter, or that can be 6 months. To judge the managerial ability of the business. Managerial ability means that how managers are conducting their business activities. If they are conducting the business activities in a good way, so it means the overall business will be doing good. If they are conducting the business in a bad way, the overall business will be doing bad, especially the operating performance, because the managerial ability is basically showing the decisions of the business, the day-to-day decisions of the business. The last one is to compare the performance of a company for different periods. It means that, for example, if there is a company and you want to compare the performance of that company for different years, for 2017, 19 and 20, then you will probably can check that in which year the sale is high and in which year the sale is very low. Similarly, you can check the other performance indicator as well. For example, the profit, the net profit, in which year the profit was very high, in which year the profit was very low. So examples of external user of financial statement analysis. So we are just checking the users of the financial statements. So trade creditors focus on the liquidity of the firm. Those parties from which you are purchasing the raw material for your firm, they are focusing on the liquidity of the firm in order to be repaid for their selling. Number 2, bondholders focus on the long-term cash flow of the firm. Because the bondholders are in the long-term contract with the business, so they are focusing on the long-term cash flow of the firm, whether they will be getting the interest, the desired interest from the company or not. So that is why they are focusing on the long-term cash flow of the firm. Number 3, investors. Focuses on the profitability and long-term health of the firm. Investors means shareholders are the other persons who want to invest in the companies. So they are also focusing on the profitability of the firm, and they are also checking for multiple years of the companies whether the company is doing good or not. The government agencies are also checking the financial statements in order to check the strength of the financial position of the business for tax purposes, because government also collect the taxes from the company. So this is also stakeholders or external users for the company. Institutional investors are those which are not the individual investors. Institutional investors are the financial you can say financial companies are such type of companies which invest in the shares of the other companies. They invest in bonds of the other companies, and for that purpose they are assessing the financial statements in order to predict the financial position of the company. Examples of internal use of the financial statements analysis. Internal users refers to the management and employees of the company who analyze the financial statements in order to make decisions related to the operations of the company. So it means that these are the people who are internal to the company. Why they are using the financial statements? They are planning about the future of the future of the company. So that is why they are analyzing the financial statements. Their focus is on the current financial position and evaluating the potential firm opportunities. They are planning about how to grab the opportunities, the future opportunities. So that is why they are analyzing the financial statements. Number 2, they want to efficiently control the return on investment for various assets and to control the asset efficiency. That is why they are analyzing the financial statements. They want to understand and they want to focus on understanding how suppliers of funds analyze the firm. They also want to understand that what are the thinking of the other parties, the external parties or the external users of accounts about the financial position of business. So that is why they are analyzing their own financial statements. Primary types of the financial statements. Then we talk about the types of the financial statements. There are 2 basic types of the financial statements. Number 1, balance sheet. Balance sheet is basically a summary of a firm's financial position on a given date that shows total assets is equal to total liabilities plus owner's equity. Or you can say that it is a written document that shows the business assets, the business liabilities, and the business owner's equity. Owner's equity is equal to assets minus liabilities. So the owner investment is equal to assets minus liabilities. Liabilities are all those obligations which is payable to the external parties, especially the creditors of the company, while owner equity is basically the funds that is invested by the owners of the business. The second one is income statement, a summary of a firm's revenues and expenses over a specified period, ending with the net income or net loss for that period. So income statement is basically a document that summarizes the revenues and expenses of a firm, of a business. So it is basically shows that whether the company in a specified period of time is going to get loss or it is going to be better and it is going to get net income. So whether the company is getting income or getting net loss. If it is having revenue more than expenses, then there will be net income for the business. If the revenue is less than the expenses, so it will be having losses over time. So it is basically the comparison of the revenue and expenses. If the expenses are higher than the revenue, then the company is going to lose. If the revenue is higher than the expenses, then the company is going to get profit. So the next is an example of the asset side of the balance sheet. The Basket Wonders balance sheet. Basket Wonders is basically a company, and this is the balance sheet of that company on December 31, 2003, where cash and cash equivalents are $90. Here I am highlighting this. This is cash and cash equivalents, which is equal to $90. Account receivable is $394. Inventories are $696. Prepaid expenses are all those expenses which is already paid. Means these are the future expenses which are already paid. Accumulated tax prepaid $10. Current assets total is equal to $1,195. Fixed assets and less accumulated depreciation of the fixed assets, because with the fixed asset we are having accumulated depreciation. In the previous semester we have talked about the depreciation, how to calculate the depreciation and what is meant by the accumulated depreciation. So over time, with the passage of time, the depreciation is going to be accumulated, and that is called accumulated depreciation. For example, depreciation expenses for 3 years, for 4 years, for 5 years, it will become accumulated depreciation. Then next fixed asset is $701. Investment long term, other assets long term, and total asset $2,169. And ABCD is basically the short definitions of these assets. In inventories, if we see inventories, there are 3 types of inventories: raw material inventory, work in process inventory, and finished good inventory. Next we go towards the Basket Wonders liability side. In liability and shareholder equity side of the balance sheet, we are having notes payable, so I am just going to highlight it. We are having notes payable. Notes payable are a short term liability which is in the written form. Accounts payable is a short term liability which can be in the written form and cannot be in the written form. Accrued taxes are all those taxes which are accrued but not yet paid, so that is why it is called accrued taxes. Other accrued liabilities, for example, this can be accrued salaries or other accrued expenses. Current liability is equal to $500. Long-term debt is equal to $530. So 500 plus $530 is equal to 1030. So the total liability is equal to 1030. Then shareholder equity. We have common stock, and the common stock par value is $1 per share. So the total is 200 common stock. It means that the total par value will be equal to $200 because there are 200 shares and one share price, especially the par value, not the market value. The par value is $1, so it means, or the stated value, or we can say the face value. So this is $1. It means the total worth is $200 if we are having 200 shares. Additional paid in capital is $729. It means that the company sold out the common stock on premium. On premium means more than the par value. How much more than the par value? $729. Retained earning. So additional paid in capital, then retained earning. What is mean by retained earning? Retained earning means those earnings which are not distributed among the shareholders. For example, a company or a business get profit and the company did not distribute the profit, rather that profit is reinvested in the business. That is called retained earnings. So we plus the retained earnings or add the retained earnings with the shareholder equity. So as the retained earning increases, means as you are investing your profit in the business, and as the retained earning increasing, your total shareholder equity will also be increasing. As in this case, by $10 the shareholder equity increases. The total liability and equity is equal to 2,106.9. So here on the right hand side we are having the small definitions of these terminologies as well. Then Basket Wonders income statement. We coming toward the Basket Wonders income statement. Net sale, cost of goods sold, gross profit. So net sale or revenue minus cost of goods sold is equal to $612, which is basically gross profit. Then sales, journal and administrative expenses. These means the sales, journals and administrative expenses, which is $402. EBIT means earning before interest and taxes. So we are having over here A, B, C and D, operating income, but it means earning before interest and taxes. It means that this is earning, but this is before $210 is before payment of interest and before payment of taxes. Now we will minus the taxes, that is interest expenses. We will minus interest expense $59, it will become $151. Then we will minus income taxes $60, then it will become EAT, earning after taxes. Earning after taxes, that is $91. Then we have to give the cash dividend to the shareholders. Cash dividend is the portion of the profit, or dividend is the portion of the profit which is distributed among the shareholders. So the cash dividend must be given to the shareholders. So this is basically $38 is the cash dividend. Then increase in retained earnings. So how much left to the retained earnings? 91 minus 38 is equal to $53. Framework for financial analysis. The next is the framework for financial analysis. Analysis of the funds needs of the firm. How you can analyze the financial statements in order to determine the needs of the firm. One is the seasonal component in the business. If your business is seasonal and in some season the product demands in the market is very high and the other season is very low, so it is obvious that in that season you will require a lot of funds when the demand is high. On the other hand, in the season when the demand is low, there will be no need for funds in your business. Other are the things which are analytical tools used in order to determine the needs of the firm for your business. That is sources and uses of statement. Sources and uses statement means that what are the sources of the funds and what are the uses of the funds. So we will plus the sources of the funds and minus the uses of the funds, and this way we will get that how the funds are used in the business and what are the sources of those funds. Statement of cash flows, in which we determine the cash inflows and cash outflows. Based on the cash flow we can determine that what is the trend of the cash flow in our business. Similarly, the cash budgets can also be prepared. The second one is analysis of the business financial condition and profitability of the firm. The second thing is that you have to determine the financial conditions and profitability of the business. So how you can do that? There are some technical terms used in order to analyze the financial condition and profitability of the firm. Financial ratios are used in order to determine the financial health of the firm. That can be used individually, that can be used over time for different time periods, that can be used in the combination, and that can be used in the comparison. In last we will be talking about that in the next lecture, inshallah, that how the financial ratios, what are the financial ratios and how we can calculate the financial ratios for the business. The last one is the analysis of the business risk. So how can you analyze the risk of the firm? What is risk? What is risk? Business risk relates to the risk inherent in the operation of the firm. For example, volatility in sales, volatility in cost, and proximity to break-even point. So these are the risk. Volatility in sales is basically risk, and if the sales is very volatile, the risk will be high. And if it is not volatile, then the risk will be low. Similarly, volatility in cost is also a business risk. So next is the determining the financing needs of the firm. If we are doing these three types of activities, it will automatically determine the financial needs of the firm. What are those activities? These are the analysis of the funds needs of the business, then financial condition and profitability of the business, then analysis of the business risk of the firm, then we can determine the financing needs of the firm. It means that the financial manager must take these three types of decisions collectively. Then you can negotiate the terms and conditions with the suppliers of the capital, like the creditors, the bondholders, the financial managers of the financial institutions, and the banks, the commercial banks, the special financial corporations like IDBP, like PICIC corporations, and all others suppliers of the capital like shareholders. You can negotiate on good terms with them. You can negotiate with them in order to fulfill the funds requirement in your business. But first you have to cover all these three activities in order to determine the financing needs of the firm. Then use of the financial ratios. A financial ratio is an index that relates to accounting numbers and is obtained by dividing one number by the other. It simply means a mathematical relationship between two figures. A mathematical relationship between two figures is called a financial ratio. Types of comparison. What are the types of comparison which we can be doing by the help of the financial ratios? That is internal comparison and external comparison. If you are comparing your own company in different time periods and different years, then it is called internal comparison. Or you are comparing your company with the other companies, with the same companies, then it is you are doing the internal comparison. What is mean by external comparison? External comparison means that to compare your company with the other companies. That is called external comparison. This involves comparing the ratios of one firm with those of similar firms or with industry averages. Similarity is important, as one should compare apples to the apples. If you are comparing apple with banana, then it is not external comparison. It means that you must have the same things in order to reach to a conclusion. You have to compare the apple with the apple in order to pick up the best apple. Then you can pick up the best apple when you are comparing apple with the apple. If you are comparing apple with the other things, with the oranges, so you cannot pick up the best apple, neither the best orange. So that is why you have to compare the same firm with the same firm. For example, you can compare the Kohat cement factory with the Kahi cement factory or with the Bestway cement factory, but you must have to pick up the same firms in the same industry. So that is external comparison, but it must be with the industry averages, industry ratios. For example, Robert Morris Associates, Dun and Bradstreet, Almanac of Business and Industrial Financial Ratios. These three are Robert and Morris Association is basically risk management associations, and these are concerned about the how to minimize the risk. That can be the credit risk, and that can be the default risk, and that can be other risk, the operating risk or financial risk in the business. And this is basically a company which associates and which gives services about the risk and risk management of different companies. Dun and Bradstreet and Almanac of Business and Industrial Financial Ratios are also giving the financial services, and they are preparing the company's financial analysis and financial statement analysis. Thank you.